We're going to start today's session with Gaurav Jain, Managing Partner of Afore Capital. Gaurav, welcome. It's great to have you here.
Thank you. It's a pleasure to be here. And I was just listening to your opening, opening sort of description of what you're doing. It's incredible, right? Because with the internet these days, there's entrepreneurs like all over the world, right? And at some level, it's unfortunate that we can't be involved in companies everywhere. We tend to have a lot more portfolio companies in the Bay Area or in the U.S. generally. We have a few outside, but it's great to see what you're doing because I think there's entrepreneurship talent everywhere, and there's great companies that are going to be built everywhere in the world. So it's actually I didn't know a whole lot about your mission, but that makes a lot of sense.
Well, and as you heard me say, 1 million by 1 million is 1 million entrepreneurs times 1 million in revenue. I did not say we are trying to fund 1 million companies, which I don't think is viable, actually. So, however, of course, we have also a large community of entrepreneurs who are in the venture path. So that's why we want to talk to people like yourself. And in particular, with your specific focus, which is pre-seed investments, we are very, very interested in hearing your perspective because, as you know, that part of the ecosystem is very underserved. People want validated businesses. People want, seed, post-seed, and now the pre-seed is where the tricky part of the equation is. So tell us about Afore Capital. What are you trying to do? How are you positioning yourselves? And let's get you introduced to our audience.
Awesome. Thank you. So Afore Capital is a $47 million vehicle exclusively focused on investing in pre-seed companies. And that makes us the largest fund that's focused on pre-seed. Mm-hmm. And my partner and I, we started this fund in 2016. Both of us had been in venture for a few years. So my personal background real quick, software engineer by training, and then I moved into product. I was one of the first product managers for Android. I did that for a few years, saw the platform go from less than 1 million total users to about 1 million new installations a day, and of course 2 billion people use it today. Then I switched gears into venture. I was at a fund called Afore Collective, doing seed investments. But what I noticed, I was there for 4.5 years, is that a seed round went from what was around $1 million to $2 million round when I joined Afore Collective in 2012 to a $3 to $5 million round. In a lot of cases, I think in 2016 there was like 98 seed rounds that were over $5 million in size. And for most of these companies, seed round was not their first round, right? They had to raise some money before there because, as you mentioned, the investors are looking for scale or looking for some level of traction, product market fit, before they're ready to invest. So these founders struggled to raise that round before the seed round because there just weren't that many institutional investors willing to invest. My partner's background is similar, software engineer. He was the first product manager at Twitter, one of the first employees, and then he was an investor in a Series A and B fund called Foundation Capital. And both of us noticed something similar, as I alluded to, that there was this gap, right, for founders to be able to raise that sort of first round of funding before there's traction, before there's product market fit, before it's clear whether it's going to work or not. And we saw that gap. I saw that as an opportunity, left our respective funds where we had a great path, but felt that we really had a passion for investing early and felt we could create value. So we left, raised some money primarily from institutional investors, so pension trusts, sovereign wealth funds, so on and so forth, who also saw an opportunity to fill this gap and have outsized returns, right? Because the competition is less in this space, you can get a pretty good valuation for these companies, and then for the ones that work, you get outsized returns. So we raised this vehicle. We've invested about 20 companies so far. Our typical check size is somewhere between kind of $250K to 600K or so. The rounds are the smallest one we've probably done is like a $330,000 round. On the larger end, they tend to be around $1 million, $1.5 million. But in all of these cases, first round of funding, these companies were not ready to kind of scale, sales and user acquisition. They really had to focus on product. And given my partner and I, my background in being product managers, having been there early at the ground floor, we could really be helpful, right? First of all, we can identify really strong product talent, which is what we look for above all else, is do you have an ability to build a product that customers will love, right? A product that's 10x better than what's already out there. Because there's no traction yet, we need to get some level of confidence that when you do launch this product that it's going to take off, right? And I think the way we do that is try to understand, how good the product DNA is on the team, what non-obvious insights that the team has around building this product. And if we get excited, we make an investment and get very actively involved with these companies between the pre-seed and sort of the seed round. Or in some cases, we've seen companies go straight from pre-seed to Series A, right? It really depends on what you can accomplish in sort of that 12 months post our investment. And what sectors, obviously, Series investors are actively investing in, so on and so forth. So we've done about 20 investments. Across the board, some are, B2B, building SaaS, enterprise software, B2C, e-commerce. So we're less kind of caught up on the exact sector that you're building a company in. We're more interested in sort of the application and the use case, right? We believe that the founders know exactly where the opportunity is. They can point us to where the world is going. And in fact, they're the ones that are going to build that vision of the world anyway. So we don't get too caught up in sort of predicting where the world's going to go. Instead, we spend our time looking for the best founders that are early where we can be helpful.
When you say early and pre-seed, can you put a bit more color around that? Are you willing to make concept financing? Like if somebody just presents the concept and doesn't have an MVP or a product, are you willing to put that 250, 300K in?
The short answer is yes. The long answer, though, is these days it's gotten so cheap to build an MVP, especially if you're building a software product, which is where 80, 90% of our investments are going to be is a software-heavy business. Or even if it's a services, business like a, Uber, for example, like a transportation business or moving stuff, it's software enabled, right? So to get something out there to show some interest from customers, you don't need a whole lot of money, right? Between Amazon Web Services, which is pay as you go, between all the open source software, which is free, I mean, these days to build a prototype, literally all you need is a laptop and access to the internet, right? For which you don't necessarily need capital and a few months of human labor. I think human labor is really where the bottleneck is, and that's what we look for, are founders that are able to build a product themselves, right? Or at least one of the founders is technical. I think the challenge becomes when both founders are non-technical and they need to go hire engineers before they can write a single line of code. Those ones are a little bit harder for us for a lot of reasons we can dig into if you'd like. So in most cases, the founders have been able to get something out there without needing any capital. So a typical trajectory would be, you're working at a tech company. It's a couple of founders. They have this idea that they've been toying with for a few months. Maybe they've been hacking on the evenings and weekends, and they get really excited. They leave the job, right? And that's when we get to know them, right? It's typically around the time when they're leaving, quitting their job and moving on. But then we stay in touch with them and help them for a few months as they are kind of hacking on products, hacking on the exact direction. And then when they're ready to, and part of the reason we don't invest in sort of that concept stage is because a lot of times that concept changes, right? Very quickly within the first few months as the engineers start to iterate. So you don't want to raise money too early from a founder's perspective either, because if you raise money getting investors excited about this direction, but you realize that's actually not the direction you're excited about for a whole host of reasons, you want to go in this direction, that becomes a little bit tense, right? Because now you have to convince the investors that is the new direction is the right direction to go in. So because the cycle times are so short in the first few months and so much is going to change, we encourage founders to kind of wait, for 3 to 4 months until they have some semblance of kind of the direction they want to run it, at least for the next 6 to 12 months, right? There's still going to be a lot of iteration. There's still going to be a lot of sort of micro pivots in the first 12 months, and something looks like in 5 years is going to be very different, and that's okay, but we need some level of clarity for the next 12 months, and hence we rarely invest at sort of the, hey, I just came up with this idea this morning, or 2 weeks ago I've been thinking a lot about it and I'm looking for some money. we tend to wait for a little bit. You know, the cases where we have invested is founders we've known for a while. They have launched products before. They have launched, you know, maybe they built a couple companies before, and we just want to be, you know, in partnership with this founder. But I'd say 90% of the companies, if not more, they have some prototype, something that we can get our hands around.
I got it. So you're basically, your sweet spot is technical founders who have tinkered for a few months and built something and has an idea of where they want to position that product, and then you take it from there. You're okay with the micro pivots, but you have some directional movement already in swing, basically.
Yeah, but one thing I want to clarify is we're very comfortable taking on traction risk, right? We're very comfortable when you build the prototype, it doesn't have a lot of traction yet, right? It doesn't make any money yet. And it's not clear if, yeah, sure, maybe 100 customers love it. Does that mean 1 million are going to like it? We don't know, right? That is something we're comfortable with. So we don't need to wait for, you know, your business and humming and hawing before we invest. But that sort of initial work, we like to see that.
But, you know, for a B2B business, 100 customers, getting to 100 customers is not an easy thing to do right away.
Sure. And for B2B, like, depends on obviously the size of your customer, right? If they're paying you $10 a month, you know, getting 1,500 customers is not hard. If they're paying you $10,000 a month, then maybe 1 or 2 is great. So, of course, it depends on
it depends on the
size.
sector. Got it.
Exactly.
So,
exactly. And if it's a consumer company, you know, you want to see even more than 100.
More than that, yeah. So, quickly, what about geography? Are you local focused or U.S. focused, global focused? What's the comfort zone?
Yeah, both of us are based in San Francisco, you know, but our mandate doesn't prevent us from investing anywhere in the world.
Okay.
You know, I'd say our strong bias is towards U.S.-based companies, or U.S. and Canada. I would say I grew up in Canada, so definitely the soft spot there. I've made a few investments in Canada. But I'd say we have a bias towards that just because, you know, we have a network there. We can be helpful, you know, for recruiting, for follow-on investments, for business development, a whole host of reasons that, you know, just we can do a much better job for you in North America. But we have made investments outside. There's a company that's based in India that we're investors in out of Afore. You know, so we're totally open to non-American investments as well, but, you know, the bar is just going to be higher. I think what we would want to see are really mature founders that need sort of less of our help and are able to, you know, tap into their local network and perhaps even raise money from Silicon Valley follow-on investors, while even though they're sitting, you know, somewhere else.
Well, the issue that you bring up India, the issue that we see in India is that if you're doing, you know, let's say B2B SaaS out of India, which is a very popular category in the Indian investment pool, you kind of very soon realize that you're going to need to build it as a global business, and you're better off being based in the U.S. because for a lot of reasons, the access to capital in India is okay right now, especially in the early stages. There is capital, but exits are few and far between. So it's from the point of view of exits, people are realizing that they're better off being a U.S. company with the Indian subsidiary as opposed to the other way around. So 2 questions. First and foremost, we'd like to learn a bit more about the highlights of your portfolio and give us some of your thought process on how you decided on these particular companies. What was it about those companies that really struck you and attracted you and convinced you that there is something interesting and important in there?
Yeah. So what we look for, as we were talking earlier, are the founders and their sort of product DNA and ability to build a game-changing product above all else, right? Because at the stage we invest, there's not much traction. It's not even clear what market you're going after. I know a lot of investors will tell you, you know, go after a big market because, you know, you're going to get a small percentage of that, and that's sort of the most important thing. For better or for worse, that's not sort of how we think, just because our best companies tend to be in markets that it wasn't very clear when they got started at the stage we invested in. So I'll share a few portfolio companies, both from my old fund, Founder Collective, where I was for many years, and then Afore. Out of Founder Collective, some of the notable ones are did the seed in a company called Cruise Automation, that was building driverless cars. That was eventually acquired by General Motors, and Kyle, who's the founder CEO, now runs autonomous division for GM. And it was a great exit for all the investors, because we invested in the seed, and it was acquired for close to $1 billion. The reason I got excited about cruise automation is I remember Kyle drove me down the 101 here in San Francisco when he was giving me a demo of what he had built, and it was a pretty primitive product, right? All it did was keep the car in between the two lanes in a highway, right? Barely, by the way, because it started raining that day and the autonomous controls went off. But it was very rudimentary product. But there was like 2 people on the team at that time. And I said, Kyle, look, I'd worked for Google before. I know Google's been investing in driverless cars for a long time. They're far along. Tesla's thinking about it, so on and so forth. This is 2014 or so. Maybe 2013. I said, help me understand, why is the startup going to thrive and win and outcompete, Google and Tesla and everybody else? He said, look, I understand it's really hard to build a very R&D heavy company as a startup, as a venture-backed startup, but all of those folks are working on the product in the lab, right? They're trying to, get a perfect product out there, and then they're going to scale. As a startup, and especially as a startup entrepreneur who thinks like a consumer product manager, I'm going to get a very small fraction of the final product out there in the market in the hands of the customer. And I'm going to gather a lot of data, and I'm going to learn a lot, because when it comes to driverless cars, data is really where, you win or lose. The more data you can gather, the better your models are. He said, I'm going to gather a lot of data, so all I'm going to launch by the end of the year is an ability to keep your lane, keep your car in between the 2 lanes and change lanes in a highway. Something very simple, which a lot of cars already have, but, I'm going to get some early adopters to try the product with the vision that I can build driverless cars down the road. And I'm going to put a big hard drive in the trunk, and I'm going to give you free car washes. And then every week you come in for a free car wash, I'm going to download all that data. Anyway, he had all these insights that were non-obvious, that made a lot of sense. There was a very lofty vision, but I got that feeling that, well, there's a lot of risk, and it could totally go to zero. But if he's right, if some of these things work out, this could be really massive, right? Mm-hmm. And that's what we look for in the companies is we don't make a list of what can go wrong, because that list, unfortunately, is just too long and too real. Instead, we look for what can go right? If the founder is able to accomplish these sort of counterintuitive things, could this be a massive business? Could this be a massive opportunity? Could this be a multi-billion-dollar opportunity, right? And does the founder have the ability to kind of go execute on kind of V1 of the product, right? Get some traction, get some usage, and then learn, right? And figure out V2, which neither of us know what that is, right? They have that ability to kind of, call them micro-pivot earlier, micro-pivoted to V2 and V3 and so on and so forth, right? And Kyle did a brilliant job at that. They're going to be launching driverless cars very soon. Another company I invested in out of Founder Collective, a company called Firebase, which was 2 technical founders. It was actually the 4th startup. The first 3 had failed. And they were building a chat engine, and as they were building the chat engine, or chat app, they realized the back-end software to enable the chat app was actually really complicated. Because you had to keep, multiple parties in sync and so on and so forth. So what they did is they took that engine and actually productized that and said, everybody else who's trying to build real-time products, real-time web apps, let's make this engine available to them. And that's when we came in, right? We said, and what I liked about those founders were very authentic, very organic, right? They'd been building this chat app and realized the opportunity was actually somewhere else, and then ran with that. They had a really interesting vision around how hard it is to build real-time products. I'd worked at Google, had seen how hard it is to build Google Docs, for example, which is sort of this real-time functionality. And if you can enable that, for engineers to build that within minutes as opposed to weeks and months, that could be pretty powerful, right? So we invested in that company that was acquired by Google, and that was a great exit for us. Out of Afore, the portfolio is still new, it's 16 months old, but we invested in a company called BoxBot, for example. Founders came out of Uber and Tesla, deep technical founders, and their insight was that, parcel delivery, right, which is, taking an e-commerce package to your house, 50% of that cost is literally in like the last 100 feet or so as the UPS driver, the FedEx driver walks around the truck, drops off the package to your house, and then drives to the next house, and so on and so forth. So what if we can enable to an autonomous robot the ability to ship a package to you, right? So they've delivered this really interesting supply chain where they can shave the cost for UPS and DHL quite substantially and get that parcel to your house. What we liked here was, again, the founders were very authentic, right? They were working inside of an Uber and Tesla. They had the right skill set. They've seen the opportunity to apply kind of driverless technology, but in a very different use case, right? And as we validated the use case, as we did some research on our own, we said that makes a lot of sense. Or we invested in a company called Overtime, started by Dan Porter, who built the game Draw Something, which was acquired by Zynga eventually, which is a great outcome for him. But he has a really strong consumer kind of product instinct. And what you noticed was that millennials these days are not watching 3-hour games on ESPN, right? They're instead consuming sports content on their mobile phones, and generally very small snippets, right? So what he does through his UGC kind of app is acquire all this high school sports content. This is content that nobody owns the rights to, right? How can you acquire this sports content and then push it through the platform, right? Push it through Instagram, Facebook, whatever different channels there might be, and get a lot of, so there's millions of these video views a month because, millennials just love this content, and it's entertaining, it's short, and it's content that they can't access anywhere else. So anyway, you can see it's a whole mixed bag of different companies and different kind of sectors and applications, but the sort of the connecting thread is very strong founders in terms of product, their ability to deliver product, their ability to understand what the customers want, having kind of non-obvious insights so they can compete with the incumbents, and in all of those cases, we invested very early.
And you're looking for unicorns?
I mean, look, that's sort of the venture model, obviously, is the companies who invest and eventually become, big independent businesses. But, we don't get too caught up on sort of what the eventual, exit outcome looks like. I think part of what we tell our entrepreneurs is stay capital efficient, right? Don't raise too much money because when you raise too much money, you're forced to become a unicorn, and you're forced to, because, if you're raising money at a $500 million post-money valuation, you can't sell it for 400 or even 600, right? You have to pass that $1 billion mark.
Exit options become really limited.
Exactly, right, exactly. And certain sectors, there's just not that much M&A activity for companies to buy, other companies for billions of dollars, right? I think in tech, you see obviously Apple and Google, sometimes or Facebook buying multi-billion-dollar companies that are still very early, but in the rest of the world, that's actually not true. So we tell entrepreneurs, just look, stay capital efficient, don't raise too much money, stay focused on the fundamentals of the business. I mean, I'll give you an example. I invested in a company called Skip the Dishes, which is a company based out of Winnipeg, Canada, of all places. It's a company basically doing food delivery. So think of like, Postmates, but for mid-market cities. So when Postmates and Uber Eats and everybody's kind of competing in New York and San Francisco, and they were, in Columbus and places that there's no other food delivery service. They built a phenomenal business. They stayed capital efficient. They didn't raise too much money. They stayed focused on profitability. They stayed focused on growth, and they eventually got acquired by Just Eat, which is a public company out of the UK, for something like $200 million Canadian dollars, which was a great outcome for the founders, right, because they still owned a significant portion of the company. It was a great outcome for investors because we did not get diluted much because they didn't raise a whole lot of money after us. We owned a significant portion.
How much total money did the company raise, and how much revenue did this get to?
Yeah, I mean, in total they raised, I want to say sub $10 million. I forget the exact figure, but it was a small number, right? Relatively small for a food delivery company. I don't know the numbers for like Postmates and stuff, but it's probably in the hundreds of millions of dollars that they've raised. Skip raised a fraction of that. And by the way, their numbers were not that far off from some of these bigger companies. So, it goes to show, and a big reason for that was because they were based in Winnipeg, right, where the cost structure is just phenomenally differently. They had something like 200 employees or something like that at the time that they exited. There's no way you can afford to have that many people in your company and only raise that little money in like San Francisco or New York, right? So,
but it's also a matter of culture and philosophy, right? I think part of the problem we have created in this industry is this, burn lots of capital and chase hyper growth at all costs and just make yourselves unsustainable for the off chance that you may get a big exit. This is not the way to build companies.
Yeah, I 1,000% agree with you, and that's what we tell entrepreneurs. I think the challenge in the industry a little bit is that there's so much capital chasing so few good opportunities that investors push these companies to raise more than they should. And unfortunately for a lot of founders, the amount of money you've raised becomes a barometer for how successful they are, which is absolutely not true, right? Given the number of employees you have in your company or the amount of them.
What is your read of your cohorts in the pre-seed segment of the market? Are there other players who are thinking the way you're thinking, or are they, are you finding good syndication opportunities in your stage?
You mean, are there other peer investors, right?
Yes.
Yeah, there are a few.
Share your philosophy.
Yeah, there are a few funds. I mean, it's an emerging category. There aren't a lot yet. I think that may change in the next couple years. But I'd say there's probably 3 to 5 funds that are serious about pre-seed. Some of them don't exclusively do pre-seed. They also do seed and other stages. But that are seriously thinking about pre-seed and have the same philosophy that we have, which is do more with less. Don't raise too much capital and so on and so forth. And we do syndicate sometimes with them, though we're not sort of dependent on the syndicate. We, first of all, like to lead where we can. So we're not waiting for signal. We're not waiting for somebody else to price around. We're very comfortable being the biggest check and pricing the round. And typically these rounds, if it's a $750K round and if we're doing 500 of that, these founders can finish off the rest with just angel investors. And in a lot of cases, we were 75% of the round, 75% or more of the round, which is totally fine. And in fact, we prefer, because we don't want the company to raise too much capital. And a lot of times they want angel investors involved in the company anyway for strategic reasons. So, there hasn't been, we're not dependent on syndicates, but we certainly love to co-invest where the opportunity is with some of our peer VCs. The other thing is, if you think of a funnel, right, there's obviously a lot of companies at the pre-seed, right? So there's just a lot of opportunity for all our peers to invest in, and these companies are obviously not obvious, but not everybody agrees that this is a good company to invest in. So, there's not a consensus a lot of times on companies anyway, which is fine. So I think that creates a lot of value for founders because now they have more optionality to raise money. So if I don't get it, you might be able to raise money from a peer, which is totally fine.
Awesome. Gaurav, this has been a very interesting conversation. We have talked to a couple of pre-seed, probably 3 out of 5 pre-seed funds have already been on the show. So we will keep, keep the dialogue going and hope to work with you going forward. Thank you for coming today.
Likewise, thank you. And I'm easy to find. I'm just G. Jain on Twitter, but also our website is Afore.vc. If we can ever be of help, our email addresses are on the website. Please reach out and more than happy to chat.
Fantastic. Folks,
awesome.
we're going to move to the